Hello, and thank you for joining today's webinar. On the 1st of March 2021, the ATO released Draft Practical Compliance Guidance PCG 2021 D1, which outlines the ATO's compliance approach to the splitting of professional services firm profits. We'll be exploring this further today and highlighting the implications for professionals in business that are subject to the new guidance. I'd now like to introduce our first presenter today, Shannon Smith, Founder and Managing Director of Smart Business Solutions. Shannon has been advising small and large businesses for over 25 years, and prior to founding Smart, worked for one of the world's leading accounting firms in Melbourne, Prague, Amsterdam, and New York. I'll be presenting the second half of today's webinar. My name is Daniel McCulloch. I'm a Chartered Accountant and Associate at Smart Business Solutions with over 10 years experience providing tax and consulting services to small and medium business. I specialise in professional services and medical accounting, and am therefore well placed to assist clients with this new guidance. So now I'll hand over to Shannon Smith, who will get us underway. Shannon, can you let us know why this is so important and we need to discuss it now?
Thanks very much, Daniel. So why is this area all of a sudden in the spotlight? Well, it's actually been something that has been a focus point of the ATO for really quite some time. And the reason is, to be honest, it's because a lot of accountants get it wrong. We actually see probably 9 out of 10 new medical professional clients that that come on board as a client of ours. Well, 9 out of 10 of them, we're actually in there having to restructure and basically correct the structure. How does it happen? What usually happens, I think many of them straight out of medical school go to one of the leading medical accountants. They set them up properly. They end up going to another local accountant, really to get a more personalised service than some of those bigger end of town that deal with a lot of people. So they want the more personal service. But these accountants are not as equipped to understand all the different nuances around the medical side. And there are some really special rules from the ATO, which probably many of you have seen along the way. What we're seeing is I guess the reason, one of the triggers from the ATO perspective, is that there are fewer practices these days actually structured as partnerships of individuals anymore. A lot of different structures are being used, and the use of these structures does actually facilitate income splitting. So what is it the ATO is looking at from the ATO guidance side of things? So they actually had some old guidance. So we actually were quite excited at that point that we were going to get some guidance from the ATO. And they originally put it out for the 2015 income year. It was aimed specifically at professional services firms. Now we're talking today about medical professionals. This also is relevant for architects, engineers, accountants, and a few others. It's used, what we say, to identify risk level for what we call Part 4A, where you're actually going from a tax avoidance perspective. Now, a lot of those clients that I talked about that we've restructured actually didn't realise that they were in a sense having a potential risk from a Part 4A perspective, when their prior accountant had put a significant amount of their I guess proceeds or their revenue into a trust and distributed it around to many family members. So the original guidelines applied from the 2015 income year. They were actually suspended from 14th of December 2017. We were actually hoping that we'd get guidance sooner rather than later, but it did take them a while to come out there. Now, the new guidance is really interesting in the way in which the ATO has gone about this. So instead of putting a ruling out, they've actually released, so it was in draft form on 1st of March, PCG 2021 D2. Now, it will actually be finalised before June 30 is what they're saying, and it will apply from 1st of July 2021. So all of our medical professional clients, we're going to be having a look and going through this PCG and making sure that you're all in the green, so to speak, and we'll go through more details on that. But once finalised, we do need to actually action this quite quickly before June 30, because if there is any restructuring that's required, we want to get this done as soon as possible. Now, they realise there may be some teething issues for this as they implement, and so it will be reviewed from and during 2022 to be finalised from that perspective. So the ATO's primary focus is on situations where an individual practitioner redirects their income to another, what we call associated individual or entity, could be a family trust, therefore lowering their effective tax rate. So as an example of this type of arrangement, a medical practice may operate through a medical practice company and a related service trust. Now, that's something very common that many of you are probably structured in. The profits of the service trust may be allocated to a spouse or adult children who are in a lower tax bracket, whereas the net profit of the medical practice company generally has to be paid to the practitioner. Now, in this situation, the combined arrangement could actually come under ATO scrutiny if the percentage of the overall income returned to the individual practitioner and the effective tax rate on the overall practice income does not fit within the ATO's low risk zone. Now, I know many of you are probably thinking, well, hang on a minute, this is kind of how I'm structured. But there are rules now, and this is where I would say our clients, I'm very confident that all of our clients won't have any issues, but we will see this coming up more and more, because there are situations where a lot of this income is distributed to the lower tax bracket personnel and not as much and not complying with the guidance that's been previously provided on the amount of percentage of income that you can put to your medical services trust. So I do suspect that this will raise some concerns for quite a number of medical professionals and probably the accountants who haven't been paying attention on these areas. So what are the steps involved to be able to apply this PCG? And a PCG is a practice guidance statement. I guess what you could say is it's literally the working paper of the ATO, and the ATO are going to use this to assess you, and this is their working. So they're basically providing it to us so that we can action it on our side to see really where we sit and whether we need to do anything further. So the steps involved, firstly, we're going to have to go through Gateway 1, the commercial rationale, and I'll go through that in more detail. Then we're going to have to get through Gateway 2, check for high risk features. Then we're going to apply the risk factors, and this is going to help us determine a risk score and therefore level on where we sit overall. So let me just go through the Gateway 1 commercial rationale. Does the arrangement reflect the commercial needs of the business? Is the structure more complex than it needs to be to achieve commercial objectives? And are there steps that only seem to serve a tax purpose? Is the tax result inconsistent with the economic result? And are the parties acting in a non-commercial manner? So to be able to apply the PCG, you need to be able to prove that what you're doing and the way in which your practice is structured is commercially focused, not just tax focused, so to speak, that there's a commercial reason for the way in which you've structured. And that's something that could be quite subjective and is going to need, there are a number of examples in the PCG and also just from experience in going through that. So that's something we'll need to, I guess, write up and document that the commercial rationale for the way in which you've structured. For example, it could be asset protection as well. Then we go on, there are the exceptions on this, and the exceptions may be minor, and again, it's going to come down to the specifics of your actual arrangement. But, we were looking at exceptions as long as the practitioner receives an amount which reflects the reward for personal effort or skill, making sure that the practitioner ultimately benefits from the distribution of income to associates. And then also we want to look at how loan accounts are structured. So there can be some exceptions if you don't satisfy that one, but it's really going to come down to your facts and circumstances around that. Gateway 2, so we've got through Gateway 1. Now we go for Gateway 2, and we've really focused on high risk features. So basically the ATO is saying, look, you can apply our PCG. If you pass Gateway 1, what you're doing is for commercial, not tax driven purposes. And 2, you don't have any high risk features that we would be concerned about from an ATO perspective. So are there any features that are covered by a taxpayer alert? So there are different taxpayer alerts put out that would be raising red flags. Are there any features of your structure that are like that? Are any of the following present? Financing arrangements relating to non-arm's length transactions, exploiting the difference between accounting standards and tax laws, assignment of partnership interests that are not consistent with some of the case law out there, and also multiple classes of shares and units held by non-equity holders of those trusts. So they're really looking out for some of these high risk type areas. So now we're going to go through some of the more risk factors, and I'll hand you back to Daniel to go through some of the risk factors and the scores in relation to the PCG.
Thank you, Shannon. Okay, so Where an IPP passes the gateways, the next step is to self-assess against the risk assessment framework to determine the type of attention that might be given to their arrangement. The draft PCG combines a number of previously separate risk assessment measures into a single methodology, and this gives an overall risk rating of low, medium, or high risk. So the three risk factors under the framework are: one, the proportion of profit and entitlement from the whole of the firm group that is returned in the hands of the IPP, the total effective tax rate for income received from the firm by the IPP and associated entities, and three, the remuneration returned in the hands of the IPP as a percentage of the commercial benchmark for services provided to the firm. So let's take a closer look at some of these now. So with the proportion of profit entitlement, essentially what we're looking at is, what portion of the total profits of the firm are returned in the hands of the IPP. And the way that this will work practically is that the higher the overall proportion of total profit returned to the IPP, the lower the risk rating score applied under the framework. In regards to the total effective tax rate, as the name suggests, it considers the average rate of tax paid by the IPP and associates on firm income, and it's calculated by summing the total tax paid by the IPP and associates and dividing by the total firm income. It's then expressed as a percentage to apply the risk score. As with the risk factor number one, the higher the overall effective tax rate, the lower the risk rating applied to the arrangement. Now, there's a couple of notes when calculating total tax payable for the effective tax rate calc. We're going to be taking the larger of the tax that would be payable on firm profits, assuming it was the only income with no other sources of income or deductions, or the total amount being paid, the total amount of actual tax paid for the year, less the amount that would be payable if firm-related amounts were excluded. So this looks at the additional tax payable by the actual recipients on their actual share of the income, assuming that they might have some other income in their return already. Now, with the remuneration returned in the hands of the IPP as a percentage of the commercial benchmark, we're going to be looking at generally accepted industry norms. So, for example, you could consider information of employees in comparable firms or industry benchmarks where applicable. For this purpose, total remuneration includes superannuation and fringe benefits. So we're looking at a total salary package. And essentially, what we're looking for is that the IPP should receive assessable income from the firm in their own hands, which reflects an appropriate return for the services that they provide to the firm. Now, we recognise that in some circumstances, it'll be difficult or impractical to determine the commercial benchmark used for the framework. So, for example, this could be, a private surgeon or someone. But the PCG allows for this in the application of the framework by applying an aggregate score in two different ways. So one, we're looking at risk factors 1 and 2 only, and on the second, we're looking at all three risk factors combined. So now let's have a look at the risk rating score table and what your score means. So scores are assessed by determining the aggregate of the points accumulated against the three risk factors that we just outlined, or as I said, 1 and 2 only if we can't use the commercial benchmark. If using all three risk factors, a score of 10 or less is required to be considered, low risk and green. And if using risk factors 1 or 2 only, a score of 7 or less is required to be considered low risk. So now let's have a look at the following table, which highlights the risk rating based on the aggregate score of applying the risk factors. So applying the first two risk factors, as I said, we're looking at 7 or less to be green and low risk. A score of 8 would result in a moderate risk assessment, and 9 or above, we might have some problems if the arrangement is looked into. Applying all three risk factors, again, to be low risk, consider green, we're looking at a score of 10 or less. A moderate risk will be a score of 11 or 12, and 13 and above. As I said before, we're going to be dealing with some issues and we might need to take some remedial action in regards to this. Okay, so now let's have a look at the ATO's risk assessment and compliance approach and the type of attention that might be applied based on the way that you score under the framework. As Shannon mentioned, Australian tax law operates under a self-assessment system, and applying the framework under the PCG is no different. The risk assessment is initially completed by the taxpayer, and the ATO doesn't receive notification of the outcome of the application of the framework prior to commencing an inquiry or review. It should, however, be noted that the ATO has really sophisticated risk engines and data matching capabilities at their end So with or without the PCG, they're likely to have some idea based on the figures that we're submitting in your returns of where taxpayers might fall based on the framework. So assuming that you fall in the green or low risk category, the ATO will only commit compliance resources in exceptional circumstances. And so the key point here that although this is by no means a safe harbour, what it means is that unless given a reason to look further, the ATO generally won't commit resources to low risk arrangements. And again, although not a safe harbour, if taxpayers follow the framework outlined in the PCG, should the ATO later change their mind on its application, they've commented that they wouldn't seek to require prior year amendments or apply interest and penalties in the event of a change of view. For arrangements falling in the moderate risk category, so the ATO is likely to conduct further analysis, including inquiries to understand more about the taxpayer's situation and the reason for the increased risk assessment. As I said, this could include inquiries, questions, things like that. I think all of the things that we'd expect prior to an audit commencing. So it's more about understanding the reason for the score rather than scrutinising at that higher level there. And for high risk arrangements, so the way that we're seeing this at the moment is that it's likely reviews may be commenced as priority and even proceed directly to audit. So for taxpayers that are scoring in that high risk category, there's definitely some issues potentially around the structure, other areas that are specifically the things that the ATO is trying to address. So what do you need to do to minimise profit allocation risk? So the good news for our clients is that we'll conduct this review for you on your behalf and communicate the results to you. What does this involve? So it involves identifying, I guess, initially whether you are an IPP affected by the new guidance. We'll apply the gateway tests, perform the risk assessment, and then we'll review the traffic light assessment to determine the ATO compliance approach. We'll also repeat this process annually. If taxpayers' arrangements fall in the moderate or high risk categories, it doesn't automatically mean that there's a problem, as there could still be sound commercial reasons to support the structure. But what it does mean is that we may consider, reviewing the current structure and restructuring, or preparing some form of an audit defence file for clients to support the validity of the structure that is used in the event of their review. Okay, so I guess now I'll hand back to Shannon. As I said, if you had any questions throughout the presentation, please feel free to put them into the box now, and we will endeavour to answer them. Do we have any questions coming through there?
Yeah, we've got a few questions here. Thanks everyone. So we'll just go through the questions. So we do keep a recording of all of our webinars that we have run. So if you want to have a look, if you go into our YouTube, like and subscribe, you'll see a lot of different videos up there that you can watch at your leisure whenever you like. We try and keep them as short and sweet as we can, but a lot of great topics out there that we just don't seem to be see available. Just to introduce our leadership team, myself, we've also got Daniel, who you've seen on this webinar, and also Paul Cunningham as well. So we're happy to help you at all. So now I'll move over to the questions. Now we do have a few questions. When you say, and so some of these questions may have come up during our presentation. When you say incorrectly structured, what do you mean? I guess what we mean about when you've been incorrectly structured, what we see from our experience when we take on new clients is a lot of normal, normal trading businesses will often be structured in a company or a trust, and you will make the most tax effective outcome as far as distributions, whether it be wages or dividends. Medical professionals, because they're actually earning the income for their expertise, so people are coming to that surgeon, not necessarily the admin that support that surgeon. There are some really specific rules around medical professionals where the ATO are very clear that a lot of that is what we call, in a sense, this personal services income. They are earning that income as a result of the service that they're providing. So we've got some really specific rules that the ATO has out there that we need to comply with. So you can't apply the same accounting principles, which we unfortunately see a lot of accountants do, to a medical professional. There needs to be a significant amount of the income that does need to be in the individual tax return of the medical professional. So that's generally what we mean on this incorrectly structured. And I guess ironically, what's come out of this PCG is you are going to be doing, in a sense, a self-assessment so that you're kind of helping the ATO rather than them contact you and say, please provide us all this information, and they calculate what your effective tax rate is and all of these scenarios. You're going to be actually helping them by, I foresee that the ATO will contact and say, please provide your PCG, so that they can assess very quickly whether you're incorrectly structured or not. So that's kind of what we mean. That's why it's really important to touch base before June 30. So if there's any changes, and look, we've done that, Daniel and I have had to restructure a client and actually go right back to 1st of July and redo service invoices, BASs, everything to fix it up. And that may be what is required under this situation. So we have another question, Daniel, and this goes back to the ratings that you were talking about. Why would you submit if you were a red or amber rating? Why would you still submit that to the ATO if you know that's going to be a problem?
Yeah, so look, I think it's, if, as I said, so the point where the ATO are going to be having a look at this is when you're first asked to submit your PCG. And so I think whether or not you submit the PCG, it's probably going to flag at the ATO's end if you refuse to send that in. And the problem is going to be that if you have an accountant, they're never going to sign off on something that's incorrect. And so if the accountant needs to get involved to help you prepare the PCG and submit that to the tax office, then I think in most scenarios, it's probably going to proceed from that point there. I suppose you probably see this a little bit more in the transfer pricing, Shannon, but what's your experience about the
practice? Yes, I guess even if it is a red or amber, you can't, in a sense, make a decision not to submit. I mean, if you're in the green, you'd feel pretty confident. As Daniel said, there is no safe harbor, but you'd be feeling pretty confident about the situation. If you're in the red and amber, I would be, if you're in the red, just know the ATO is definitely going to come knocking. They're going to respond back to you. And if you're in the amber, they still may come knocking. You may have a perfectly good commercial reason, which actually brings me into the next question that someone raised. The gateways seem to be very subjective. Who can say what is commercial? It really comes down to your business story. And that's why you may be in the amber, but you have a perfectly good explanation for it from a commercial perspective. So it's about telling the story. The PCG is just going to give the ATO a bit of a shortcut for where you're at. And those that are proactive, I think you really need to go through the PCG analysis and know before June 30, hey, I'm in the green, I'm pretty good to go, so that you're not going to be faced with the situation. Because if you did get asked to submit and we did a PCG analysis, let's just say this was September, you got asked and we did a PCG analysis on a new client, so we hadn't done the structure, and it's a red or an amber, what are you going to do? You're either going to have to restructure, I guess, right back, which in some instances that may not even be possible. Yes, we can amend some BASs, we can change things, but sometimes we actually can't go back and amend some of those aspects. And so, yes, it is very commercial when you look at the gateway. The commercial factor is very subjective, but again, it's about building your story and putting that story together. I guess there's one more question, which nearly a bit ties into what we talked about before, Daniel, but why aren't other businesses subject to this? For example, a retail shop or manufacturing, why are they focusing on medical?
Yeah, look, and that's a really good question. And to be honest, it is an oddity in tax law that all businesses are not treated, the same. And so I think that what the ATO are probably getting at here is that given the nature of the businesses of professional services and the fact that, the income is primarily derived, through personal exertion, and also combined with the fact that going back to recent years, the ATO have probably found that for medical businesses and the like, that some of these laws have been somewhat pushed and abused a little bit. So I think they're really trying to plug some gaps here. And yeah, I mean, look, it's interesting, and I definitely come from the school where I like things, a level playing field and things to be fair and equal, but these are the laws that have come out and the guidance that's been provided. And so we're going to do our best to comply with that. Do you have anything else to add there as well, Shannon? Or?
No, I think that's, yeah, it is. It is just coming back to this, the fact that it is, yes, they've had a big focus on medical professionals, but as Daniel said, all professionals, and it comes back to that a lot of that income is generated by that one person. And I guess that's been the focus of how can you divert the income that's generated by one person. One could argue in some of these other business structures that it was income for one person as well, but maybe they're in retail, et cetera. It's just slightly different, but yeah. No, so that's all the questions that we have. Did you have something else, Daniel?
Oh, look, I was just going to say, look, it seems like they're really trying to stop this. Is things are purely an artificial nature to achieve a tax outcome.
Non-commercial.
Exactly, and that's much the same with most areas of tax law and where the attention is placed. So
yeah. Great. So we've got no other questions. If anyone has any other questions, otherwise we'll finish up now. But thanks very much for joining us. I hope you got a lot out of this. As soon as the final PCG is released, we will let you know if there are any changes. From what I've seen so far, I don't expect that there will be. But as soon as that comes out, we will update you all and give you another update. But thanks very much for joining us.
thanks, guys.
Thank you.